Good afternoon. This is Ruth McCambridge. I'm the editor-in-chief of the Nonprofit Quarterly, and I want to welcome you all to our newest webinar entitled The Financial Risks of U.S. Nonprofits and How to Manage Them. We're so pleased to be able to talk to you today about this topic that is so very important to your nonprofit's stability. In the past year, we've seen a lot of alarming things that have the potential to threaten nonprofit revenue streams at several levels. Nonprofits have the advantage through all of this of being extremely resilient and agile, as we always have been, but we need to be prepared to adapt our practices if we're to continue our important work. And one of the things that means is that we need to be ever more knowledgeable about what the indicators are of increased vulnerabilities. Understanding of risks and how to mitigate them in your nonprofit is an element of preparedness that nonprofits cannot afford to overlook. This grounded practice workshop today will help staff and boards identify and address risk in their own organizations. It draws on a recently released national-based study of nonprofit financial health based on Form 990 data by SeaChange Capital Partners, Wyman and GuideStar. The report itself is entitled The Financial Health of the United States Nonprofit Sector, Facts and Observations. It's also based on similar studies that have been done in New York and Philadelphia, and you'll hear more about the Philadelphia one in a while. In this webinar, we will identify tactics to strengthen financial resiliency in your nonprofit. For those of you who are board members, staff members, CFOs, and regular staff in nonprofits, this is incredibly important for your kind of financial literacy related to what it is that you do. I do want to say that today we will be taking questions at the end of the webinar at about a quarter of the hour. I will try to choose the ones that seem to be most relevant to you, the listeners. I do want to say before you start logging in your one favorite question in all of our webinars, which is, can we get the slides and the audio after the webinar? Yes, you can. And it will be both posted on our website, and we will send it to anybody who's registered after this session. We don't have a sponsor for our presentation today. So one thing that I want to say to you is this: each one of these presentations costs us as an organization. And so since we don't have a sponsor today, you can help to keep us doing these kinds of things by sending in a donation immediately after after this webinar. We will send you a handy dandy donate button in the missive we send to you after the webinar that will contain this and related publications. So don't forget that it actually helps an enormous amount to have the donations from you when in fact we don't have a sponsor for one of these. Today I want to welcome our guests, and I'm very proud to kind of share this space with them for a little while. John McIntosh, who is a partner and board member at SeaChange Capital Partners, and Phil Fitzgerald, who's the director of grant making at the Philadelphia Foundation. They're going to help us discuss this important information, and I want to say that I've been incredibly impressed with a series of reports that have been in this vein, and so I'm very proud and also thrilled to listen to this report and the answers to your questions later. And with that, I want to pass it over to John McIntosh. Remember that we will be coming back to you at about quarter of to answer some of your questions, so don't forget to log in your questions. So John, take it away.
Thanks very much, Ruth. Thanks everybody for calling into a topic which, let's face it, on its face is not all that exciting: financial risk management. I think what we're going to try to do over the next 40 minutes is lay out what we discovered in the most recent report, both at the sort of national high level, but also at the local level, which is where a lot of, I think, the nonprofit action is, and that is where Phil is going to speak specifically about the Philadelphia experience. And I hope we leave lots of time for questions at the end. Next slide. Okay, so why is risk management a hot topic? And in particular, why did SeaChange, who was really, my organization exists to make grants and make loans, why did we get involved? I think it's because everybody from board members to executive directors to funders and policymakers are increasingly focused on financial risk, and we didn't see that much to guide them. I think they've been focused both because of some high-profile failures, FEGS in New York, for example, Hull House in Chicago, but I think also a general sense that it's tough out there, that the status quo is unsustainable, and that it isn't getting any easier because of the impacts of tax cuts, because of the increased demand from the opioid crisis, because of the challenges in the short term on nonprofits from managed care, continuing growth and inequality. And so we were really reacting to what we saw as a need in the market. In response, we've done 4 things, and I encourage you, if you have interest, to find these reports. You can find them all on our website, GuideStar, the Philadelphia Foundation. There's lots of places you can find them. The first one was really addressed to nonprofit board members in New York, which was about 2 years ago. Following up on that, and at the kind invitation of Phil and the Philadelphia Foundation, we did a second report specific to Philadelphia. The report we're going to talk about today is at the national level, and also we did, in some ways, a different kind of deeper dive specifically into human services, together with the Alliance for Strong Families and Communities, and that report's also available. But in every case, our goals were threefold. One is to just provide some facts for discussion. Particularly board members don't really have the information to put the financial health of their not-for-profit in context. I have heard many times board members from large, financially strong organizations tell me that they're representing small, financially weak organizations, or vice versa. There just wasn't the data out there to put financial results or financial characteristics into context. So that was number one. Number two was to try to create some actionable recommendations, as well as what Ruth might agree would be some perhaps not actionable, but at least food for thought. And the third was some sort of call for action. That's the consistent measure here. And now Phil's going to talk a little bit about Philadelphia, which was our second report, and in some ways is the most relevant because so many nonprofits operate in one and only one location. And so much of the work that needs to be done that's not within the 4 walls of the nonprofit is in the local community. So Phil, take it away.
Thanks, John. Next slide, please. So a little bit about us. Founded in 1918, the Philadelphia Foundation, or TPF, strengthens the economic, social, and civic vitality of Greater Philadelphia. A publicly supported community foundation, TPF manages more than 900 charitable funds established by its donors, which is about $430 million in assets, and makes over 1,000 grants and scholarships totaling over $25 million each year. Our report was commissioned with the intention of presenting actionable information for our community's nonprofit organizations, their leaders, funders, policymakers, and the general public. It follows a 2010 nonprofit study TPF commissioned, which offered a comprehensive look at nonprofits in Greater Philadelphia. For the purposes of this report, we looked at organizations located in the 4 suburban counties surrounding the city: Bucks, Chester, Delaware, and Montgomery, as well as organizations within Philadelphia itself. TPF thanks the authors, GuideStar, Oliver Wyman, SeaChange Capital Partners, as well as Nadia K. Shmivonian, who's the director of the Nonprofit Repositioning Fund, for all they did to make this report a reality. And thanks to Ruth and her team for making this webinar possible today. So residents in Greater Philadelphia rely on nonprofits in many facets of everyday life and community. This almost $16 billion sector provides critical services and amenities that impact quality of life, often health and safety. As this report shows, a good portion of the sector in our region is in dire financial shape. What's more, this report uncovered some new data points. Specifically, location and financial viability do not necessarily correlate. Organizations in Philadelphia and those in the surrounding counties face the same financial challenges and as a result are just as fragile. As funders, we have to ask ourselves, what do communities do if these organizations fail financially? What will be the impact on vulnerable families and individuals served by those nonprofits? Nonprofit organizations in Greater Philadelphia are slowly coming out of a financial crisis of the last decade, which included a budget impasse at the state level. As they head into a hard to forecast political environment in the future, financial discipline, smart growth, and strong governance will be crucial. This is especially true for nonprofits providing health and human services, which rely on funding from government sources that have continued to shrink. It's key that the organizations themselves and their leadership, including the boards that oversee them, understand these realities. Next slide, please. The Philadelphia context and what TPS has learned from 10 years of capacity building grant making. So since 2007, TPS discretionary grant making has taken on an organizational effectiveness focus, putting us at the forefront of creating and sustaining a healthy and resilient nonprofit sector in the Greater Philadelphia region. This approach has three pillars: examining, promoting, and funding sound fiscal, governance, and leadership practices. We know that good governance, strong leadership, and solid financials do not necessarily lead to bigger impact and better outcomes for communities and individuals. However, we do know that organizations can neither achieve results nor fulfill their missions without these three pillars as a solid foundation. From our work, and as this report shows, it's clear the need for capacity building continues to grow, and the types of supports that organizations need continue to broaden. From our work with organizations directly supporting communities of color and immigrant and refugee communities, we've learned that a one-size-fits-all approach does not yield the desired results. For example, what is considered good management or standard practice in some organizations can be completely unrealistic and unachievable in others. So, as you read through the recommendations in the Philadelphia and national reports, keep your own organizational context in mind. We have also learned that the composition of boards of directors and leadership teams matter. We always encourage organizations to embrace the broadest definition of diversity. This includes a diversity of skill sets, gender, ethnicity, geographic representation, socioeconomic background, and a range of abilities. We have further learned that organizations that make room for stakeholder input and constituent voice in their decision-making have the most well-received and usually the most effective impact. So this report has been well-received by our community and much discussed in Greater Philadelphia, both within the nonprofit sector and by those who support it. And we are pleased to participate in today's discussion. Back to you, John.
Thanks, Phil. Okay, next slide. So what did we learn? So we crunched the 990 data for about 220,000 organizations, representing about $2.4 trillion of expenses. And just to put that in context, that's roughly 10% of the workforce. And I think the median nonprofit is fine. I mean, I'd be pleased if SeaChange was in this position, making 2% margins, 4.5 months of cash in the bank, a good balance between government money, 75%, and private money, 25%. That's not too bad. But if you dig deeper, since there is no average nonprofit, you see that there are a large number of organizations that are either really in trouble, and I would say the 7 to 8% that are technically insolvent, that's big trouble, or the 30% that aren't looking too rosy, they've lost money over the last 3 years, or the roughly 30 to 50% where things are fine, but they don't have a lot of margin for error. And I think NPQ was quite right to call out some of their fellow journalists for being a little bit shrill in reviewing this report. These groups aren't failing. They're not in trouble, but they don't have a lot of margin for error. They're close to the edge. And I think that's a theme that you're going to hear, that many nonprofits that are doing well, that are doing great work, are nevertheless, for all sorts of obvious reasons, close to the edge. They don't have a lot of margin for error. And everybody from funders to board members to the government needs to recognize that. Next slide. Now, I said in Philadelphia, and it got a good laugh, so hopefully you'll laugh when I say this, though I can't hear you. If someone starts talking to you about the nonprofit sector, the best thing to do is just leave the room. Because unless you're a tax lawyer, there really is no nonprofit sector. The nonprofit sector includes a huge variety of organizations. 2/3 of the organizations that file 990s, and the tiniest ones don't, but even of the groups that file 990s, 2/3 are less than $1 million. But those organizations, though I think they're very important to American society, are only doing 2% of the work as measured by spending, an imperfect measure, but still. At the other end, only 2% of the organizations are $10 million or more, but they do 80% of the spending. And so to lump those together doesn't make a lot of sense. Related point, the larger organizations are overwhelmingly government funded. And so whereas the smaller ones often have more of a balance. Again, very different. And finally, since most of us kind of think we work in the real not-for-profit sector, which excludes what I'll call the eds and the meds, higher education and hospitals, just remember that whenever someone talks to you about the nonprofit sector, 25% of those organizations and almost 3/4 of the spending are hospitals and higher ed. So I think we feel it's very important as a funder, as a board member, as an ED, when you're thinking about how you're doing and what's possible, not to compare yourself or even talk about nonprofits broadly, but to look at your sector, your size, because that is what it often is determinative. And for example, it's very clear that some sectors, for again, all sorts of obvious reasons, are much more philanthropy-based, whereas others are much more government-based. Environmental organizations, religious organizations, arts and culture, most of those organizations are 50% plus philanthropy. Whereas health and human services, hospitals, youth development, much, much less. And so I think our plea, perhaps not to the executive directors who are on the phone, but to trustees and policymakers, is please stop talking about the non-for-profit sector and dig down into the size or the sector that's more relevant. As Phil said, geography doesn't matter much, doesn't seem to matter much. Within a size and sector bucket, we don't see a lot of meaningful geographic distinctions, but sector and size matters a lot. Next slide. Now, if you disaggregate, what do you conclude? Size probably matters a little bit. The bigger groups are no less bankrupt, or said in a more positive way, they're similar levels of insolvency, big and small. It's actually possible that the larger groups face more sort of cash and liquidity issues, and they certainly have lower margins. But it's hard to be a big group that performs really badly for long, because unless someone bails you out, you go bankrupt. Whereas the smaller groups generally have higher margins, but there's a much wider range. So size matters a little bit. Subsector matters a lot. Hospitals, human service, education, much more debt, much smaller reserves, much less philanthropy. The other groups, much more philanthropy, less debt, larger reserves. And as Phil said, geography doesn't matter much. And so as we'll talk about at the end, if you're interested in benchmarking your own nonprofit, try to find the peers that are most reflective of your sector and size, because that's where you'll get meaningful information. Next slide. So a lot of groups have no margin for error. And to me, that's no surprise. And there's certainly no shame. And again, I think most of the people listening to this call understand this viscerally, but I think we need to remind business folks and folks from outside the sector that, number one, not-for-profits attack the hardest problems. If they were politically easy, the government would do it directly. If they were financially easy, the market would do it. So we're working fundamentally with a hard set of problems. Most of our funding comes from inflexible funding, which is often what I'll call cost minus. We don't know quite if we're getting what we're getting, but we absolutely know it's less than the fully loaded costs. Many organizations face one-way bets, a Medicaid audit, for example, a lawsuit where, if it happens, it's going to go against you. It's sad but true that philanthropy taken as a whole seems pretty fixed. If you look at the data post-war as a percentage of GDP, or if you prefer relative to the size of the economy, philanthropy hasn't moved much. And that doesn't mean that we should all give up and not beat up our board chairs and others and development directors to get out there and raise money. But as a sector, let's just raise more money is an incoherent strategy, because the truth is philanthropy seems largely fixed. Second last, what's called cost disease. Many of the things we're doing are very people intensive. And so we have struggled as a sector, and I think we'll continue to struggle to get some of the technology driven productivity gains that we would get if we were making cars. Many of us are doing people intensive, psychosocial interventions, and there's a limit to how much technology can help us, even if we can afford it. And then finally, I think particularly in technology and in the back office, many not-for-profits do struggle to recruit and retain the right people. So if you add all that up, it's not surprising that we don't have much margin for error. But while we shouldn't be ashamed, it means we really have to focus on financial risk. Even though we would rather spend all of our time thinking about program or strategic planning or growth, many of us do not have the luxury of doing that. We need to focus on financial risk because we have little margin for error, and because many nonprofits have no way to recover if they really get in trouble, and also run the risk of becoming what I've termed a nonprofit zombie, which is you get to a point where just to keep the lights on is using all of your resources, your capacity to innovate, to really deliver excellent program is gone, because mere survival consumes all of your resources, and that's not a place you want to be. And if you're in deep distress or going bankrupt, that's really hard. It's hard on the people you serve, and it's also hard on your staff. And nonprofit staffs, that's not what they signed up for. They signed up to work hard. They signed up to be passionate, but they didn't sign up for Silicon Valley, where they know 3/4 of the organizations are going to fail. And so I think it's particularly hard for them. And so all that means, I think it's incumbent on organizations to focus on risk management alongside strategic planning, alongside program, because most of us can't afford not to. But it also means that funders have to help us out, because I don't think we can do it alone. Next slide. So we have a red phone at SeaChange, which rings when people in big trouble call, and sadly, it rings a fair amount. So that hard learning, plus some research that we did for our New York report, has made us pretty confident that we've identified the factors, most or many of which are in the picture when a nonprofit fails. And let me just bang through them. And it's pretty depressing, but quite frankly, if you hear many of these things applying to your organization, disconnect from this call now, call your board chair and say, Jim, we got to talk. So the first is, most of the nonprofits that fail were fragile to begin with. They weren't the ones that had 2 years of cash and then suddenly it all went wrong. They started in a pretty fragile position. Again, not to blame them. Most of them reported having a long-standing challenge in recruiting and retaining a strong CFO, or if you prefer, finance director. And then something happened. It could have been the departure of the executive director, I sometimes joke for some not-for-profits, that would be the best thing that could happen to them. But for others, it's really a body blow. It could be the non-renewal of an important funder. It could be a real estate project that suddenly went over budget. It could be a call from Medicaid saying, we think you owe us $1 million. But something happened. They were fragile. They didn't have a great finance function. Something happened. And perhaps surprisingly, the group had failed to do scenario planning, and in particular had failed to think in advance of what they would do if this event, which was often quite predictable, happened. The board didn't really know what was going on. They might have known how we were doing versus budget or how this year compared to last year, but there were things going on in the background that they didn't know about. Once the crisis hit, the board didn't get timely information at the appropriate level of detail. And now this is where people really cry. Honestly, I've been in interviews where people get to this point and they really cry because they said, you know what? And once we realized we had to do something, we waited. And it was the waiting that killed us. So once they knew that they had to do something, they waited. And at least looking back, the people we interviewed often said that they suffered from magical thinking, that there was some view, perhaps when different choices could have been made, perhaps when there was still the time and capacity to make wise choices, that there was some magical thinking that the donor was suddenly going to arrive, or they were going to sell the building for $5 million that no one had valued at over $3 million. So this is the anatomy of failure as we have seen it over the years. And sadly, I think it's pretty accurate. So what do? Next slide. We think that nonprofits should do a couple of things. And I want to tell you right now, since SeaChange is a small nonprofit, that 2 days before we published our first report, I woke up in the night in a cold sweat and realized that we did none of these things. Not one. But we do them now. And that's not, I hope, a self-congratulatory tale. It's just an indication that, as Phil said, I think you can do some version of each of these, regardless of your size, regardless of your capacity. You can take a stab. And the only thing that's missing is will. That has been our experience, personal experience at SeaChange, that if you have the will to do this, you can do it. And we really believe that these things can matter. And I would say, in addition, we have found non-for-profits that do each of them and who says, you know, it really helps. So the first is review our data, or if you can find better data, if you're part of, you know, the Cultural Alliance of Greater Toledo, and that's the relevant peer group, and you've got better data. So find some data and use ours if you can't find anything better, and just see where you fit amongst your peers in terms of size and margin and reserves. Not because, oh my God, we're at the bottom, this is terrible, but just to give you, and in particular your board, some context. Number one. Number two, try to do the following things. First, assign explicit responsibility for risk management, either to a committee of your board or to the whole board, but point to a few people and say, you all are in charge of making sure that we're sensible about how we monitor and consider risks. If you were a bank, you would have a risk management committee. That makes no sense for not-for-profits. Risk is one thing, but it's not the only thing. If you started a risk management committee, they would soon find nothing to do. In fact, we talked to a not-for-profit who started a risk management committee, and after 6 months, they found nothing to do. But maybe you stick it in your finance committee, maybe you stick it in your audit committee. Don't pretend the whole board is interested in this, but find a few good people who are interested in taking this on and explicitly assign it to them, and try to craft some sort of risk tolerance statement or risk appetite statement that summarizes your approach to risk management in the way that you have with mission and vision and maybe logic model. Those are woolly things. It's not exactly clear what they mean or how to do them, but we all recognize they're important, and we feel the same thing is true for risk management, trying to craft some sort of statement. SeaChanges might be something like, let's make sure we always have 18 months of cash in the bank, don't have a deficit more than, don't have a deficit 2 years in a row, and have a good plan if one of our partners leaves. Something like that. That basically summarizes our approach to risk management. You're going to be different, but try to do that. Number two, as Phil said, make sure you have a board that has at least some people who are capable of helping on the risk management side without getting all sad and demotivated about the mission of the organization. Some people can do that and some people can't, but you need a few people who are capable in parallel with loving the art you make or the children you place in foster care or the math you teach at the same time to help you on the risk management side. And if you don't have those people on the board, find them. The third thing we would say is, and this goes back to my first point, periodically scan the environment and remind yourself and your board of what's going on. Not every quarter, but if something big has happened, like value-based payments is moving into your community, or the area where you work and lease your building is gentrifying and rates are way up, don't presume that your board knows that. Don't presume that you know it. You're so busy day to day. If you don't force yourself periodically, maybe once a year, to go out and scan what's going on in your operating environment and report back to the board, you'll lose sight of that. And those are the things that can often get you. Fourth, nonprofit accounting is terrible. I'm sorry if there are accountants on the phone. And yet so many nonprofits are slavishly addicted to reporting internally in a way that largely follows their audit. You can't believe how many $100 million plus organizations I've seen that report to their board about postage, where postage is a $2,500 item. So really think hard about what are you going to report, how are you going to report it to your board, because that will help a lot in risk management because you'll already be highlighting the things that matter. Second last point, and probably the most important, do a little bit of scenario planning. Think about what are the 5 or 6 or 7 or 4 or 8 things that, while you don't expect, could happen and would be material, and try to think about how you would respond. That's a much easier exercise in advance when heads are cool and when you have time than when it's happened. I'm sure it would be a body blow if Ruth left NPQ, but if they'd already thought of that as a risk factor and had already talked about what the plan would be, that's going to be a lot easier than if suddenly it's like, oh my God, Ruth's gone, what are we going to do? And a lot of risk management is really about having the time to make wise choices. And so anything you can think about in advance rather than after the fact is going to help you out. We know many organizations that have had crises, public relations crises, because they work in child welfare. And the ones that knew that was possible and already had a crisis plan, already had a pro bono PR firm in place, were much, much better than the ones who said, oh my God, we need to call a PR firm. So think about the scenarios that matter, talk them through with your board, and try to craft a plan for what you would do. And if you're a larger organization, I think recognize that you may even need a living will. That if you're providing vital services to vulnerable people, you have to entertain the possibility that something will happen where you simply cannot survive, and think in advance about what you would do to reduce the impact that your organizational failure has on the people you serve. Banks have to do that. And again, we think for the larger organizations, SeaChange doesn't need to do that. If we fail, I mean, really, we're not leaving too many people in the lurch. There'll be some half-finished report unpublished. But if you're working with vulnerable populations, you really need to think about, if we can't make it, who are going to take those kids? Universities are forced to do that. They have to have what's called a teach-out plan, because you can't strand kids midway through their degree, midway through their financial aid. They have to do that. Most not-for-profits don't, but we think it's responsible for the larger ones providing vital services to think about that. And finally, part of risk management is a willingness to simply say no, that there may be things where it takes your mission forward, it takes your program forward, but it's simply too costly to take on. Let's say one other thing on this page. Most of these scenarios turn out to be financial problems, but they don't start that way. You know, a crisis that gets misreported in the local tabloid, the problem is that there's been a crisis that's been misreported. Now, it may turn into a financial problem, but it didn't start that way. And so I think while these things ultimately turn into financial problems, it's a big mistake to think, oh, what are the big 5 financial problems we could have? It's more, what are the big 5 problems we could have that could turn into financial problems? And then finally, I think it's very, very hard for us, particularly as passionate as we are in the sector, to recognize that sometimes we can't manage the risk prudently on our own, and that the best answer is a partnership, a collaboration, a merger, or in some cases, even an orderly wind down. I mean, Nadia Schmavonian, who Phil mentioned, ran public-private ventures, and after a series of things happened, she recognized, and she brought her board along, that it was imprudent to try to continue to go it alone. And she did a very public wind down, and she wrote a paper about it, which you can find on our website. That's a very, very hard thing to do, but it may be the best thing to do in a tough situation. Okay, Phil, over to you on funders.
Thanks, John. Next slide, please. Some of these things are going to echo what John said, but I will take it from a funder's point of view, I guess. But what we can do is encourage grantees to look at these reports with their own organization in mind, and remember context matters, and adopt some or all of the risk management practices recommended. Over the past decade, our emphasis on unrestricted general operating support and targeted capacity building grants to improve organizational effectiveness put us in the vanguard of institutional funders, locally and nationally. We know that not every funding institution can make this a priority, but whenever possible, we recommend that funders make grants that are unrestricted and multi-year so that organizations can have strong balance sheets and built reserves for rainy days. Additionally, when grantees are in crisis, encourage them to explore all options, offer support in the form of advice, outside expertise, and if possible, grant dollars. Funders should also encourage grantee organizations' boards to go beyond compliance. It's not just about having a lawyer, a banker, and an HR specialist. You have to have honest conversations with grantees about board composition and make management, governance, and financial reviews a routine practice of your grant making. We realize that financial stability is just one way to assess the health of the nonprofit sector and nonprofits in general. But of course, success in achieving one's mission matters, and impact metrics are increasingly being adopted, which also is essential. It's an essential lens. We hope that you use these reports and others like it to get a fuller picture of your nonprofit, and that by implementing these recommendations, you continue to make day-to-day differences in the lives of your region's residents. Ready for questions, I guess.
Great. Next slide. There you go. Questions.
Discussion. Okay. This is the time that we've been waiting for. So I want to just talk for a minute about formulas. So you talked a lot about the importance of understanding what kind of organization you are, which really, to some extent, is made up of what your mission is, what your absolutes are, what your variables are, and what the requirement, kind of the transaction costs of each one of your revenue sources is, because that can vary very different from one revenue source to another. It can vary enormously. And one of the things that you and I talked about ages ago, John, had to do with the whole FEGS situation, in which you had a formula in which FEGS, which was the largest social service agency in New York, just kept growing and growing and growing. And when you actually looked at their revenue, reported, the government grants were growing, but the fundraising wasn't. What's wrong with that picture? And this, I'm using this as an example because I think to some extent, nonprofits don't understand sometimes their own formulas.
Look, I think you're right. And I think when you say nonprofits, sometimes executive directors, but often boards, you know, we're scared with good reason to talk too much about overhead. It's a good way to get all 700 people on the phone today going bananas if we start to talk about overhead. So I don't want to say that, but I do think there's a dynamic in many organizations where you just know that government will not, in most cases, cover the fully loaded costs. And so the larger you get, probably the smaller the percentage of your revenue that comes from philanthropy, because in most local markets, there's some limit to how much philanthropy you can raise. And certainly the lower the amount of unrestricted philanthropy you can get, because that's probably coming from your board or the gala, or if you're lucky, the Philadelphia Foundation. And so you're often getting into a more and more precarious situation as you grow, not because you're big, but because you're more government funded. And that may be balanced by the efficiency that you get, because we do believe that there are often some efficiency benefits to being larger, but those lines are going to intersect at some point, that even if you're getting the full efficiency benefits of being larger, as you get more and more government supported, you're going to reach a breaking point. That is something that we've seen all the time. The other thing that's sort of related to that we've seen is the tide comes in and the tide comes out. Groups get a big grant, and it's supposed to be a one-time grant to do a one-time thing. The challenge is it is a one-time grant, but it's not quite a one-time thing, because you bring the people on a little bit before you get the grant because you're so confident you're going to get it. And then after the grant is gone, because you're quite rightly optimistic, you keep those people on, or you keep the activity a little bit. And that spending in advance of this one-time grant and after it's gone, again, can be enough if you had no margin for error to sink you. So I think those two things really need to be well understood, and it takes a real desire, again, to put that sort of Dr. Spock Vulcan part of your brain on and think about a nonprofit that you really don't want to think about as a business. Think about it as a business and really try to understand what's going on from a financial standpoint and not get surprised.
Right. Maybe we can go to you, Phil, and just talk a little bit about the report about the Philadelphia nonprofits, and what was it in that report that surprised you most, that you looked at and said, oh my gosh, we could do something about that if we were to act differently ourselves? Were there any revelations like that for you guys in this report? And did you engage the rest of the philanthropic community at all about, those kinds of findings?
Yeah, I mean, so I think what would surprise us is that we have been so responsive, and we've been touting general operating support, capacity building support for these many years, and now there's a wave of funders nationally that do this work, but many still don't adopt it. So it was good validation to know that we are supporting nonprofits in the way they need to be supported, sort of the way John was just talking about. And we definitely have a lot of philanthropic partners here in Philadelphia who are trying to build capacity building into their grant portfolios. I think what's hard is boards, foundation boards, wonderful people, but they're not necessarily nonprofit executives, and they don't necessarily understand the business model of nonprofits. So bringing a grant to your board and say that this is not, this is general operating support, and we cannot say that this actually is going to result in 200 more children learning how to read. It's hard. It's really hard. But the response to the report has been great, and a lot of organizations have been trying to adopt some of these practices and using this report as a basis for some of that change.
Yeah, interesting. And John, have you, with the other localities that you've worked with, particularly New York. Have you noticed any kind of differences between those
Yeah.
geographies? I know you didn't, you said you didn't notice much, but did you notice any?
Not really. I mean, look, and we say this in the report, but I want to say it out loud. You know, you have to know what you're getting with 990 data. I think it's the best broad data set out there. And I think if you're trying to paint a broad picture about the sector and elements within it, it's just fine. But it's a pretty blunt instrument. And so first of all, we strongly discourage people from making any high stakes decision about any particular not-for-profit based on 990 data. I'm going to give you an example. You could have, you know, Ruth's Foster Care, and then you could have the Ruth's Foster Care Foundation, separate non-for-profits in 990. There's no way to link them together, but they're really one entity, right? And so that's a long-winded way of saying there are small differences geographically, but I don't think they're big enough to be convinced they're real, given the vagaries of the data. What I think we have seen across the country, but particularly in New York, is you know, a real willingness, and I don't think it's the reports, I think it's something in the water, to actually put a little bit of time on task at the board level about risk. You know, we have heard from organizations saying maybe we should spend, you know, up to 10% of our time, you know, not talking about program, not talking about finance in terms of how are we doing against the budget, but more just, you know, thinking a little bit about the future and what could happen and how we'd respond. And that's been very gratifying.
So I want to just dig down a little bit more on that in response to a question that one of the participants asked, which is, what if your organization, we just talked about a primarily government-funded organization and what the risks are in that, some of the risks. I mean, there's also risks of cash flow, liquidity, and all of that other stuff that goes with that particular enterprise model. But one of our participants asked, well, what about the primarily philanthropically supported organization? What are the risks there particularly? And maybe you can just discuss for a minute, because I think it's interesting to contrast what the concerns would be there versus the concerns of a primarily government supported organization. Are there different things that need to be
absolutely. So I think it's a sort of a schizophrenic conversation in that, you know, and again, I've said that talking about the sector makes no sense, but now I'm going to talk about the sector. That as a sector, and particularly in human services, you know, all the action from a service standpoint is in the larger organizations that are overwhelmingly government funded. So you can't sort of say, oh, well, they're just different, because they're societally, they're where the action is, for better or worse. But the vast majority of EDs run smaller organizations that often have much more of a balance. And I think for them it is different. I mean, I think it is trying to find a balance. That the government organizations, it's tough to generate the margin to put some reserves away. It's just, you know, it's just mathematically extremely difficult to build reserves when you're 98% government funded, because it's going to be really hard to keep much margin, if any, on that 98% government funded. I think if you're privately funded, it's a matter of having the discipline to build your reserves to a level that you think is comfortable, and to do the hard work of understanding what comfortable means. Because I think being in that 30% of the organizations that are never more than 2 payrolls away from the abyss is not a comfortable position to be in. But at the same time, you know, these organizations don't exist to build reserves. They don't exist to be financially stable in perpetuity. And so, like, let's put away as much as our funders will let us isn't very helpful either. And I think for those organizations, you know, I think we need more nouns and fewer adjectives. Many not-for-profits, when you say how much reserve or cash do you have, they say not much. And you say, and how much do you think you need? And they say more. And that's not very helpful. I think what's helpful is, you know, we've averaged about 6 weeks of cash, but when we've looked back and we've thought about how some of our funders are 92 years old and we're not in their estate plan, or we're under depreciating the building, we think 6 months would be a good number, and we're working with our board to get to that number over the next couple of years. And we have a plan with our funders to kind of grind it out. That's the kind of conversation you can have if you're largely philanthropically funded. But again, we think, I have 6 weeks, I want 6 months, I'm gonna do it over 3 years, we have a plan, is a whole lot easier than, we don't have enough cash, I wish we had more. But you still need to have the discipline to do it, and to position it with your board and your funders that you're not just squirreling the money away, that there's a good reason that you think these are the right level of reserves. It may be that sometimes you're paid late by the government, that you do have some government money and you don't have a line of credit, and so you're funding that. Just going through that work, I think, is something that is a challenge for privately funded organizations, but is also a real opportunity.
Yeah, and I want to add something to that. John, you're absolutely right. Creating opportunity to work with your funder, whether it's an individual or an institutional funder, and explaining your business model and how things run. Because, like you said, maybe you have government funding, or you're a school and you get all of your funding in the summer, and you have to make it all the way until spring before you get any more deposits. So making sure they understand your business model, but also making sure you have a relationship with the institution and not the program officer or program director, because if they leave or things change, or if the board shifts focus, then you are vulnerable.
Yeah, I would say, in those kinds of organizations, the whole idea of scanning the environment becomes really important, because that stuff can happen really quickly. We've seen plenty of foundations that have completely changed their focus over a period of a few months because they've changed their executive director or one thing or another. And if they comprise too much of your budget, or they're followed by other local funders, you can have a really big problem really quickly. So it's, these are horrifying things to think about, but they are the basis of the scenario planning that we really need to do. And they have implications for how much time we spend on one thing versus another. How much time do we spend tracking what philanthropy is thinking about? And how do we treat that information? Not that we should always, do what they're going to do next. Absolutely not. But how do we manage around those kinds of things? So I wanted to ask a couple of other quick questions. I know we don't have a lot more time, but the FASB regulations, the new regulations that require a little different kind of planning around liquidity, and other pieces, how useful do you think that would be in focusing boards?
So I think, and I'm not going to claim to be an expert, thank God, but I think that one of the places where the for-profit companies, and I'm really thinking of the publicly traded companies, do have a healthy discipline, is that securities regulation requires that they segment their business and describe it financially and in what's called the management discussion and analysis in a way which will highlight the important issues for the investor. So you have a proactive obligation to segment yourself in the segments that you think make sense, and to display yourself in a way that people understand. And if you actually don't want to do that, you have to get permission. You have to say, Your Honor, for competitive reasons, even though the best segment here is iPhone sales, I don't want to discuss iPhone economics because my competitor Samsung is there. But you have to. Accounting in the not-for-profit sector has been sort of completely the opposite. I don't know what the best segments are, but program, management, general, and fundraising ain't them. And I don't know what the best segments are, but unrestricted, restricted, where unrestricted in the real world people think of as like kind of cash, but it's often a building that you probably don't actually own in some economic sense or can't sell, not helpful. And so I do think that FASB is going in the right direction to better presentation, but I would say that there's still nothing that prevents you in the notes of your financials or in your management reports to present and segment things the way you want. I mean, I think one of the interesting things that some nonprofits already do in their unrestricted net assets is they take out the property. They say, you know, you may think our unrestricted net assets are 10, but just so you know, 11 is our headquarters that we can't sell or we can't deal the program. And then excluding that, we're -1. So I guess a long-winded way of saying, if you're just going to follow FASB, I think it is better, particularly around the segmentation and the liquidity. But I think even the new FASB isn't good enough, and that nonprofits should try to think about how they could better explain themselves internally and externally. The other problem that we see all the time is that people don't do their fund accounting very well. At SeaChange, we're really lazy, and so we don't just do fund accounting. We have separate bank accounts. We have like 6 flavors of money, and so we have 6 different bank accounts, because I don't want to dip into Strawberry for something I'm only supposed to spend, you know, vanilla money on, at least not unknowingly. And I think a lot of nonprofits get themselves in trouble that way, that they get a restricted grant, they spend it on some other purpose unknowingly because they think that it's going to be okay at the end of the year, and then it isn't. And the new FASB won't really help you with that. I think you need to find other ways to understand that problem and to solve it.
You know, today, John, you've aired all your dirty laundry about SeaChange. So who knows if anybody's going to really even listen to you anymore? But
I will say one other thing, and this is something which I couldn't believe, but it's true of SeaChange. Most not-for-profits in this country by number, I believe, have more board members than staff.
Yeah.
And the business guys on your board don't run a business like yours. They don't run an 8-person not-for-profit or an 8-person restaurant. And so I do think that we need to be on a constant mission as executive directors to educate ourselves and then to educate our boards, because risk management is a team sport. And if most of the team doesn't really have a clue, it's tough to win.
Okay, and here's what I want to say. After having assaulted you with that, I went through about 3 years at Nonprofit Quarterly wondering why the board wasn't making the call that we were no longer viable. So I'm with you on this, and I just want to reassure people on this call that organizations can look very, very shaky on the surface, and yet be absolutely resolute in what they're going to do and end up being successful. But it is important to take all of these things into consideration when you're thinking about your future. You want not to be sidelined by something untoward happening that you could have predicted. Or that you could have made some plans around. And so this stuff is understanding. First of all, I want to just make a really clear distinction here. Understanding your own enterprise model, where your money comes from, what the transaction costs are, whether that is actually helping you do your mission-oriented work, what other kinds of things you have to understand about that business model is incredibly important to you as an organization. If you don't understand it, you cannot expect your funders to understand it. And if you can't say, this is why we need this capital structure, so much in the bank for reserves, so much in the bank for liquidity, so much in the bank for research and development, you can't assume that funders are going to understand that either. So you're putting yourself in a very bad position, not understanding your model. So that's absolutely the first step for the people on this call, is to understand what are the vulnerabilities we face, what kind of money is best in here, what kind of money do we need for what kinds of activities, and how much of it is restricted and unrestricted. And all of that goes into understanding that basic model. Would you agree with that, you guys? Okay, so all that to say that there's much more where this information came from. We're going to keep on these issues of business model reporting, and the whole realm of funders' understanding of the need to look beyond the program grant, to make sure that the organizations that they're working with are actually healthy enough to be able to meet their own promises to the public on behalf of the funders and of themselves. So thank you very much, Phil. It's been a pleasure, and congratulations to you for getting such a handle on how to be helpful to your local nonprofits. And thank you very much, John, for the excellent research work that you've been doing in this area. And we hope to have you back really soon.
Thank you.
Thanks.
Okay.